There is a number buried in almost every fund's fact sheet that most investors have never consciously looked at. It is not the fund's past returns. It is not the manager's name. It is a small percentage, often something like 0.75% or 1.20%, and it is called the expense ratio, and over 30 years it can cost you more than the entire amount you originally invested. Here is how it works. An expense ratio is the annual fee a fund charges to cover its running costs, manager salaries, administration, marketing. It is deducted automatically, a little every single day, directly from the fund's assets. You never receive an invoice. You never write a check. The money simply vanishes from your returns before you ever see them. Now, 1% sounds trivial. On a £10,000 investment in year one, the difference between a fund charging 0.03% and one charging 1.00% is just £71. Genuinely not worth worrying about, right? Except that is not where the story ends. Because the fee does not just reduce your return once, it reduces the base that next year's growth applies to, and then it does it again and again. That is compounding drag. The same mechanism that makes compound interest work for you, now working against you. By year 10, that gap between the low-cost and higher-cost fund has grown to roughly £1,700 on that same £10,000 investment. By year 30, over £35,000, more than 3 times the original amount you put in. Scale that up to £100,000, and the difference in final wealth between a 0.03% fund and a 1.0% fund over 30 years is approximately £278,000. Gone. Not lost to a bad market, lost to a fee. Now, the obvious pushback is, surely you pay more because you get more. A skilled active manager, the argument goes, earns their fee by beating the market. And mathematically, that is true, if they actually beat the benchmark by enough to cover the cost. The problem is the data. Morningstar tracked active U.S. equity funds over 10 years and found that roughly 93% of them underperformed a simple index after fees. Not some of them. 93%. This is why the expense ratio matters so much for long-term, passive investors. When you hold a broad index fund, you're accepting that you will not beat the market, but you're also ensuring fees do not silently spend your future. The difference between the largest S&P 500 ETFs illustrates this plainly. Some charge 0.09% annually, others charge 0.03%. A third of the price for access to essentially the same underlying market. None of this is about finding a magic low-cost fund and getting rich. It is about understanding that every pound you hand over in fees is a pound that will never compound. You cannot control whether markets go up or down next year. You can control this. Check your fund's expense ratio today. It takes 30 seconds. The number is on every fund fact sheet. And once you know what you're paying, you can decide whether it is worth it.